Hey everybody, Greg Barron here, the professor of real estate. Thanks for joining us again today on our YouTube channel. Today, I'm going to talk to you about 4 essential things in financing for commercial and some residential properties. You're going to want to stay tuned. So today we're going to jump into some discussion over interest rates. We're going to talk about how a project is financed, and you need to learn 4 basic concepts in order to really present your project, financially model it, and determine if it's a viable project or not. These 4 items are commonly called a capital stack. And for a long time, I didn't know what a capital stack was. I just knew what senior debt was. But there's actually 4 levels of capital stack that we're going to go over. The first one is senior debt. The second one is mezzanine debt. The third one is preferred. And the last one is common equity. Now, you don't always use all 4 of those simultaneously. Sometimes you just use senior debt and common. Sometimes you insert some preferred equity into it, and many times you don't use mezzanine, but I'm going to go over it just the same so that you'll have a really good understanding of how this whole capital stack works into creating financing for a project that could hopefully be a go deal for you in the future. Prior to getting into the capital stack, though, and giving you a few examples, we're going to jump into Performable Plus in just a minute and show you. I want to talk to you about currently what's going on in the interest rate environment. Probably most of you know the Fed had the opportunity in January to lower the Fed fund rate after 11 rate hikes over the last couple of years, and they didn't do anything, primarily because inflation. Inflation is still just hanging on. It's still being stubborn, which is affecting all of us in the commercial business. It's affecting you that are just homeowners looking to refinance or to buy your first home. We've had a couple of head fakes here in the last few months, some optimism that people were looking forward to as long-term rates and 30-year mortgages dip below 7%, but it's just hanging on. So I wanted to go over a couple of articles that had recently come out because everybody wants to know still, what are the predictions for what the Fed's going to do? They passed it over in January. Their next rate discussion is going to be March the 19th, and then the next one after that is going to be sometime in June. I've recently looked at a couple of articles because I've got projects right now on the books that I'm trying to really insert some interest rates in, both in construction carry and in long-term carry. So this is near and dear to my heart. I'm playing the same game as most everybody else is, and maybe a lot of you are. We're trying to predict, well, should we start it now or should we start it in March? Should we start it in July? Because a 25-point basis difference will make a difference in the viability of your project. But first, let's jump into a couple of articles that are pretty recent. I think these are only a couple of days old, and this one comes out of Yahoo Finance. I think I say that, Yahoo, the Texas slang, Yahoo Finance. It says, the strength of the economy and the recent data we have received on inflation mean it's appropriate to be patient. I think you've heard that from me lately. Careful, methodical, deliberative, pick your favorite synonym. Waller said Thursday in a speech in Minneapolis, whatever word you pick, they all translate to one idea. What's the rush? And basically what they're saying is there is no rush on the Fed's part right now to lower rates. Basically what they're saying is the economy's strong, the labor market's still strong. So until we can crush inflation more, we just don't have any desire to lower it because in their mind, it's pretty stubborn right now. So let's just leave it the way it is. It goes on to say, as recently as mid-January, investors and some economists were betting on the Fed to start lowering rates at its March 19th to 20 meeting. Markets have since significantly dialed back expectation for early and rapid cuts, shifting wagers on the first move to June or July on the heels of reports showing job and price gains well above forecasts in January. Well, that's good news to a lot of people if you're in politics but it's bad news for those of us that are looking for rate reductions to further stimulate our pipeline of projects, because we're still hanging on to the same figures that we've been hanging on to for a long time. So let's go to the Fed data to show us exactly where we are with Fed fund rates. And you'll see right here, if I can get my pointer right over it, in January of 2024, Fed fund rates are still really stubborn at 5.33. Now, Fed fund rates is just the rate that the banks have to buy money at, and most banks are going to charge you 300 basis points over that. So what that basically means is we're still looking at a prime rate somewhere around 8.25 to 8.5 for guys like us, good credit, long history, good projects to borrow money. If we've got a construction loan attached to that for any length of term, for anywhere from 6 to 14 months to 18 months, it's even going to be greater than that. Even our price right now is well over 9% for construction loans. It's just not abating. So we're taking the position, you know what, let's go ahead and plug those numbers in and see what it does to our projects. It's just going to be stubborn for a while. If you ask me what my prediction is, and I know I gave you some back in December or January, my prediction is maybe 1 to 2 rate reductions of 25 to 50 basis points, which really isn't going to move the needle a whole lot in financing over the next year. I think it's going to be well into 2025 before we see rates into the low 7s, if they even get that far. So what does that mean for us as opportunists that are in the investment side of real estate? Well, what it means is hopefully we've got a stockpile of cash ready to deploy. We're starting to enter knowing right now that this is going to be as good as it gets for the next year. So we're starting to look at a few more deals and, so to speak, having a new normal attitude for the rest of the year. It also means that there's going to be increased opportunity, because the longer these high rates keep structured like this, the longer the opportunity for projects to be picked up, because there's just a lot of people it's going to crush. And I hate to say it, but there's a whole asset class that are going to have to now refinance that before they thought, well, there's going to be some optimism. So they're either going to refinance, or they're going to give their keys back, or they're going to have capital calls with their investors. All that means cap rates are going to increase, values are going to decrease, and it's going to reset, giving us an opportunity to come back in and have some good pickings for another run-up cycle in the years to come. So there are a lot of us that are actually looking forward to this. I'm not real excited that rates are being, as stubborn as they are, but it is going to push more product into the pipeline, because quite frankly, people aren't going to hang on. Investors aren't going to want to continue to push cash into something that's already going to have a 20 to 30% reduction in value. So before I jump into a definition of a capital stack, let me just show you how somebody like me is looking at a project right now and doing what I call a sensitivity analysis as I'm looking at what the rates are going to do. Luckily, I've got a great software system called Performa Plus, not out yet, but it will be in a couple of months, that I can plug rates in and do an immediate sensitivity analysis. And if you don't have something like this, I got to tell you, this is one of the essential things that you need to get proficient in if you're going to become a real estate developer or an investor that goes through acquisitions or value adds. You cannot do this without a great financial modeling system. Either you got to do it in Excel, which we've got an Excel add-in on this particular product, or you've got to have something like this where it's a plug and play that does that immediate sensitivity analysis when you introduce different data points. But let me just show you what a 25 to 50 basis point difference makes in your project. So you can see this particular project is something they introduced last week. It's a medical facility, a small $3 million facility. It's next to a hospital. multi-tenant. So it's a pretty good deal. It's a value add deal, but it's got a construction component because it's got a value add feature to it. And I plugged in, as you can see, 8.5% because as of yesterday, that's what my commercial bankers are telling me I need to figure for a construction loan. And then on the long-term loan, after it's stabilized, I've been quoted an 8% loan. So I plugged in those two figures. My loan to cost ratio is right at 66%, and I can change these variables as the rates change and as an LTV changes. I plugged in those, and I want to scroll down and show you at 8.5% construction loan, 8% long-term loan, amortized over, let's see, what did I plug in here? Amortized over 20 years. What my cash flow before taxes would be, and this is fully stabilized. My cash flow would be $67,000, and that is a triple net lease, meaning my tenant's going to pay all electrical, water, sewer. They just give us a check every month. And my cash on cash return, which if you followed me before, you know I've got some specifics for my buy box. Cash on cash has to be there. This particular cash on cash, the way that this is modeled, is right at 9.72%, and it ticks up a little more here. So it fits well within my buy box. Okay, so let's do this though. Let's change, this is what I love about this software. Let's change my interest rate on my construction loan to 8%, and then let's change my interest rate to 7.5%. Remember, I told you that I don't expect any more than 25 to 50 basis points reduction in the next year. But let me be just a little optimistic. So I'm going to throttle back on this to 7.5%. And then I'm going to come up here and hit save and watch it do its magic. And ultimately, it will recalculate everything. So let's go back down to the cash flow before taxes, and you can see here I've gone from 67,000 to 75,000. So it's a pretty good jump for me and my investors. And my cash on cash has gone from 9% to, I'm sorry, this is cash on cash with principal reduction, but all things being equal, it went from a little over 9 to 10.3%. This particular input, I wanted to show you why a 25 to 50 basis point reduction does make a difference. Now, my project still is well within my buy box at these rates, but it would really get better if I got a 25 or a 50 basis point reduction in the next year. So if you're looking at a project, you need to make sure that you're getting several term sheets and pounding on those lenders for every bit of reduction or every bit of savings that you can get. I guess savings isn't the right word. It would be reduction in interest rate that they're going to give you. And I might also add, if you increase your term, that's also going to make a difference in your debt service coverage ratio. So get those lending term sheets from those bankers. Work on it, because 25 to 50 basis points in this environment, it makes a big difference. Okay, so I'm going to show you two graphs that are really helpful to me to describe what a capital stack is. And basically, you heard me say before, you've got senior debt, you've got mezzanine debt, preferred equity, and common equity. The first two that I talked to you about, senior debt and mezzanine debt, are debt. Duh. The next two are what we call equity. It's preferred and common. And I like this chart because it shows you from a standpoint of potential return and risk. On this side, it starts with senior debt as low and going up to high. What that means is that the risk for senior debt is low, and the higher up you go, to common equity, your risk gets higher. The same thing applies to your return. The return for senior debt is low. Think of a bank that's lending you a project for 8%. Well, every time you move up, you're going to increase that return level to these debt institutions or these investors that you have in your capital stack. So it goes from low return to high return, low risk to high risk. Let me show you another graph that will maybe give you a better example that I like to look at. It's going to describe each layer as it relates to risk and return. So again, this is a different graph, same thing with a little more explanation. Low risk and reward on the bottom side. As it moves up in the capital stack, it's high risk, high reward. So in senior debt, this is the primary mortgage on your property. And I'm going to jump back into Performa Plus in just a second because we actually have all four of these and it'll become a little bit more clear. Senior debt, think of something that's being financed by your bank or an institution. No gains from appreciation. All they have is an interest rate that you, or an interest rate plus principal that you reduce and they get. And by the way, banks exist to lend you money. It's a debt-based society. They borrow money from the Fed at around 5.3. They sell it to us at around 8.5. So their margin on that is around 3%. Not a big margin when you think about it. So that's why they have covenants when they lend money to you that are getting stricter and stricter, by the way. So they have no gains from appreciation. They have fixed interest payments. They are collateralized by the property, and they are first to receive payment in this stack. And they are the lowest risk. As you move up, there's another layer in there called mezzanine debt, and I'm not going to talk too much on this because, frankly, most of our viewers don't use mezzanine debt. It's used more in institutional type of products that are 15 to a billion. A little outside the scope of what we usually talk about, but mezzanine debt still is a part of the capital stack. And I'll give you an example too. If a banker is lending you money at 8 to 8.5, a mezzanine lender is usually going to be a shorter term, a gap loan, and I've seen those as high as 10 to 15% in this market. They're higher returns in senior debt. They're secured by the ownership shares of the property in many cases, not necessarily a lien like you would have from senior debt. It's repaid after the senior debt, but before the preferred equity and the common equity, and it's medium risk. Next, as we move up the capital stack, you have preferred equity. And I'll show you this in just a second because this is important because there are a lot of investors out there that only want a specific return on their investment. They don't necessarily have an interest in the property like common equity does. This particular capital stack, it has less upside than common equity. It has a higher yield than debt and receives payments before common equity, and it's higher risk. Now, where most people park it is in common equity. That's people like me. That's sponsors and that's investors. That's general partners or limited partners. They own shares in the particular project. This is an investor's money in a transaction that reflects basic ownership. It is the highest upside potential. It can receive cash flow distributions, has basic ownership interest with potential tax benefits. That's a biggie, by the way. Preferred, mezzanine, and senior don't get the luxury of having depreciation benefits that those of us who have common equity have. That's why most of us are in this game, along with the appreciation of the asset. There's usually no collateral. We are the last to be repaid, and it's the highest risk. This generally speaking, is how most deals are structured. If I had to tell you what are 90% of most deals that I see are done, it's with senior debt and with common equity. So let's pop into Performa Plus right quick. Performa Plus right quick. That's a tough one. And I want to show you how it actually works into the financial model. So this particular project, again, I fully loaded all the data points that I need. I've loaded the land acquisition price. I have come down here and I've entered my construction costs for all of the tenant finish here in detail. I have some site development costs. We went over this last week. Have some soft costs for architectural civil engineering. The thing that I love about this particular software, it's sequential. It goes down in order of the way that you would naturally build or develop a project. I've got some fees and upfit costs that I won't go into. Then I go into my capital stack. Now you see I've got it in order of the preference of how it would be used from high to low. So we've got senior debt here, and in this particular example I've got a construction loan and I've got a long-term mortgage. So in this particular application, if I didn't have a construction loan, if it was just an acquisition, I would just turn off this feature right here and it would go straight into your long-term mortgage. But this one, I've got somewhere in the 10 to 12 months to do some value add construction. So it actually figures a construction loan before it hits stabilization into a long-term mortgage. Mezzanine debt, I don't have any on this one, but if I did, I would enter the debt that I would be taking on here with the interest rate and the term. I come down here to preferred equity. If I had investors that I needed to raise additional capital for, I would have a certain amount of units, say 100 units at 1,000 a piece, and adjust it for an amount per invested unit and what percentage I would give them as a rate of return, say it's 9%, and then that's all they would get on the equity, and then I would pay them back as the project had matured. Don't have any preferred equity on this particular model. And then on common equity, this is where most of you will play in the sandbox. Common equity is you as the developer, or we call it sometimes as a sponsor. And then I've got several examples here of limited partners that are also contributing money. So this particular software has the ability to add each one. See, in this particular, and this is an example, by the way. This is not an actual. I've got 30% investment percentage here for $300,000, and then I've got several people here who I've made the names up on that have 15, 30, and 25. All those equal 100% of the equity that I need to raise, and you'll see right here in common equity about $1 million in common equity. But this particular feature, again in the capital stack, allows us to enter each and every percentage of ownership and how much they're contributing. That's important because ultimately I'll go back to my model, and then I will hit save, and then it will recalculate based upon the capital stack then what my performance should be on this particular project. Do me a favor, if you enjoy this video, be sure and like and subscribe. We want to keep pumping out these videos to help you take advantages of the coming opportunities that I know are going to present themselves in the months to come. Thanks everybody for joining me again today. I know that was a lot of information, but you've got to create some muscle memory even if you're not doing deals. Jump into a system like this, like Performa Plus or a good Excel financial modeling worksheet to prepare yourself for those projects or those potential investments that you're going to want to look at in the months to come. Remember, educate, evaluate, so that you can ultimately execute for your own personal wealth. See you soon.